Hey there YouTube. So in this video I wanted to cover the IRS Form 1099-S. This is the proceeds from real estate transactions Form 1099 filing. This 1099 is filed generally by the closing agent in a real estate transaction, and it is filed to report the gross proceeds from the sale by the seller of the property. Okay, so if you have, for example, we have John Smith, taxpayer. He owned a piece of real estate. He sold it to a buyer. The broker, the closing agent here that closed the transaction for the two parties is required to file this, provide a copy to John Smith, and provide a copy to the IRS. So we've got an example 1099-S here, and then I've got a slide in front of us with some information, and then also an 8949 example that we'll look at as well. So if we go back to this slide first, just to cover some of the background here, like I already said, if you're a homeowner and you sell real estate, the closing agent, or it might be an attorney, title company, whoever's closing the deal must report the real estate proceeds to the IRS on a 1099-S and send a copy to the seller. So this is generally mailed to the seller by February 16th following the close of the year where the property was sold. And then a copy is electronically filed with the IRS by March 31 of the same year. Okay, so for example here, if John sells his home in October 2020, he's going to get a 1099-S sometime on or before February 16th, 2021. And then the IRS is going to give, the IRS is going to receive a copy of that by March 31st, 2021. And that again is filed generally electronically by the closing agent. Okay, now here's what's really important. Every person or every party that sells a piece of real estate and gets a 1099-S, you must report this on your tax return. Even if you generated a loss from the sale, or even if you think that the gross proceeds from the sale are negligible. And here's why. The IRS is only getting the gross proceeds information. They don't know what your cost basis is. So what they like to do is they like to assume that you sold a property for almost a zero cost basis, so you have all gain. They will do that. I've seen that happen many a times. So you always want to make sure you report the transaction, accurately report your cost basis, and then so if you have a gain, you'll pay tax on the gain. If you have a loss, you'll report the loss. But as I've noted here, if you have the loss from the sale of a personal property, it's not you can't deduct it. There's no capital loss treatment for the sale of personal property. Okay, so now what's also important to highlight, if this is your principal residence, so you've lived there 2 of the last 5 years, you might qualify for the principal residence exclusion under Section 121, which means that if you had a gain, you can exclude a certain amount of the gain, right? That's the nice thing about the principal residence exclusion. And then lastly here, as I've already highlighted, if you realize a capital loss from the sale of the property, you still have to report it, but you might not be able to get a tax deduction. And so that's what we're going to look at here in my example. So if I go back to the 1099-S, we have here's the closing agent, Not Real Broker LLC. Date of closing, the gross proceeds from the sale are $450, and John Smith, taxpayer. The transferor is the seller. Okay, so John is the one that sold the property. Here's the physical site address for the property. And again, he sold it for $450,000. So what does John need to do with his tax return? Well, if we look at his 8949, this is a long-term transaction because John held the property. Actually, sorry, let me go back to the slide and cover the fact pattern again before we jump into it. So let's say you or John here buys a primary residence for $475. He lived in the property for 4 years and sold it for $450, incurred a $25,000 loss, right? So we have gross proceeds of $450 over $475K in cost basis. So we took a loss on it. Unfortunately, that happens, right? Now, the gross proceeds of $450 are still reported to the IRS, right? That's what's on the 1099-S. And again, just to reiterate, the IRS does not know that you sold the property at a loss. They're going to assume that you sold the whole thing for a gain. They will absolutely do that. So it's important that this transaction is reported on the 1040 to make sure that you're not unduly subject to any kind of taxes on gains that you just didn't realize. So if we go back to the 8949, again, this is a long-term transaction because John's held it for 4 years. Or a number of years, whatever it is. And so this is his main home. That's an appropriate description. Date acquired, date sold. There we have the gross proceeds from the sale, and then cost basis is what John bought it for $475. Now, Code L here is an adjustment to report a non-deductible loss, right? So a personal loss. So if we didn't have Code L here and we didn't have column G with the adjustment, we would have a capital loss here of $25,000, which he's not allowed to take. If you're an individual taxpayer, you're only allowed to deduct losses on the sale of property if it's being used in a trade or business or it's being held for investment. In this case, if you have personal use property, you cannot take a capital loss. And so for that reason, we're reporting this so that the proceeds match up with the 1099-S, but then we have our cost basis, our Code L adjustment, and then $25,000 to zero out that loss. So the total gain or loss that eventually flows through to his return is zero. So yeah, not a great fact pattern for John here. Sold the property at a loss and then got hit twice in the fact that he can't deduct the loss against the other investment gains that he might have realized from trading stocks, bonds, or whatever else it might be. So so this fact pattern here, very, very important to illustrate why you always need to report these items, even if you incurred a loss. Because again, we want the IRS to be able to match up this proceeds column with the information they get on a 1099-S. Otherwise, there's a chance that they could send you a CP2000 matching notice, which you don't want to get in the mail. So that covers it for this video. I hope you guys thought that was helpful. I appreciate you sticking through to the end here. If you have any questions, please leave me a comment below, and I look forward to seeing you again on the next video. Thank you.